Hello and welcome to the Friday Market Update. And this week we're going to be tackling one of the biggest myths out there. And it is the Fed is going to cut interest rates, so mortgage rates will drop too, right? Well, maybe, but probably not in the way most buyers think. So let's break this down together because understanding what's actually happening in the market can help you and your clients make a much smarter decision right now. So first of all, rates held steady this week. Mortgage rates pretty much went sideways, which is great news. I'm happy with that. And in this environment, we're holding just above 6.5% on a 30-year fixed conventional loan, according to Mortgage News Daily, my favorite nerdy website. And yes, I read it daily, so you don't have to. It's not the most exciting website out there. Now, we all know the biggest hurdle for buyers today isn't necessarily the price of the home. It's the monthly payment. And that payment is tied directly to interest rates. Lower interest rates, lower payment. Higher interest rates, higher payment. So even small moves in rates can make a big difference in affordability. Now, the Fed is set to cut rates, but that's not the same thing as mortgage rates. There's a lot of buzz out there right now that the Fed will cut interest rates at their next meeting on September 17th. In fact, the odds are over 90% that we'll see a 0.25% rate cut in the Fed funds rate. So naturally, I get asked this all the time. Bill, if the Fed cuts rates, does that mean mortgage rates will go down too? It's a fair question and one that people need to know. But here's the truth. The Fed funds rate and mortgage rates are two completely different things. The Fed funds rate is the short-term interest rate banks charge each other to borrow money overnight. It's a tool for the Fed to use to influence inflation, stimulate, or slow the economy. It's just a tool that the Fed uses, and they set that interest rate. But mortgage rates, those are market driven. It's kind of like Wall Street. They move based on the buying and selling of mortgage-backed securities on Wall Street. So while there's some long-term correlation, the Fed funds rate does not set mortgage rates. So Wall Street moves on expectations, not headlines. So let's put this into a football term because I love football. We're going into football season. So ladies, I hope you get this, that I have to do this. So imagine your team is up by 4 points. There's 10 seconds left. They're way back in their own 20-yard line, and it's basically 10 seconds. They have to go 80 yards to get to the end zone, and you're feeling pretty confident about it. You've basically already won. You're already kind of celebrating. So you place your bet, and you just go, yeah, we're going to win. And then that's what Wall Street does. They bet what they think is going to happen, not what has happened. So right now, they've already priced in a 0.25% rate cut. That's why mortgage rates have already dropped by about 0.2% in the last 30 days and over 0.5% in the last 3 months. But sometimes the unexpected happens. The quarterback drops back and throws the Hail Mary as far as they can, and it's caught in the touchdown. The underdog wins. The game flips upside down in a second. And in the mortgage world, that Hail Mary moment is when the Fed does something unexpected, like not cutting rates at all or cutting more than a 0.25%. And when that happens, mortgage rates can react sharply. If the Fed cuts more than expected, that could actually do push mortgage rates even lower. So if instead of a 0.25% rate cut, if they went 0.5%, we could see even lower mortgage rates. But if the Fed holds steady and they don't make any rate cut, that could trigger a jump in mortgage rates because Wall Street all of a sudden said, hey, that's not what we expected. And their bet was wrong. So why waiting for the Fed might backfire? This is what I always caution buyers when I hear I'm waiting to buy until the Fed cuts rates. If that's your strategy, you might already be behind the curve because they've already lowered rates. The market has already moved in anticipation of the Fed's decision, and they're anticipating that they're going to make a rate cut here in September. That expected rate cut, it's already priced into the market. So when the Fed makes the actual announcement, hey, we're cutting rates a 0.25%, there's a real chance mortgage rates don't change at all, or worse, they go the opposite direction. So what should buyers do right now? Here's a simple takeaway. A bird in the hand is worth two in the bush. We all know that expression. Rates today are already benefiting from Wall Street's anticipation of a Fed cut. If the payment fits your budget and you found the right home, this could be your moment to jump in and take advantage of the sellers. They're giving free money away. You can take that right now, because if you wait for the magic 0.25% drop that everyone's talking about, you might miss it entirely. It might already be here and you're too late. And remember, if rates drop again, you can always refinance. But if prices go up or rates spike back up, you don't get a do-over. You don't get a do-over with this. So if this helped better explain what's going on in the market with rates, please feel free to share it with someone you know who's been kind of sitting on that fence on the side. Things happen. Agents, feel free to forward this to your clients. I'm here to help however I can. Until next week, as I always say, be the buffalo, charge into that storm, give them confidence that they're making a great decision so that they can move forward with clarity and confidence. Hope you have an amazing weekend. We'll see you next week. This is Gaylord out.